My name is Jeremy Green, Director of Advanced Planning for CBS Brokerage. Today I'll be discussing a technique called the charitable remainder unit trust with you, which is an income tax planning technique used during lifetime. Now there's other techniques that you can use a CRUT for during testamentarily. We're not going to, in the interest of time, and we're going to keep it short and use it for income tax planning during lifetime specifically. Now, the type of clients we would use it for are clients that maybe have come to you in the past and said, I have got an asset I need to sell. And your advice in the past may have been sell some now, sell some next year. But as you already know, there are instances where a client has such a large amount of value that it wouldn't make any difference. They'd still be in the highest tax brackets. So this would be an alternative to that advice. The type of assets we need is something that would be low cost basis, high appreciation. It could be marketable securities, or it could be business interest. If it's a business interest you're thinking of contributing, you need a valuation. Additionally, there should be no signed purchase agreement in advance of the contribution. If there's a signed purchase agreement, the tax ramifications are fixed, even if they haven't transferred the shares yet. So if it is an S-Corp also, that CRUTs are not a permissible shareholder of S-Corps. However, there are a lot of workarounds to include using goodwill of the corporation or even owning the CRUT at the S-Corp level. You do need a client that's thinking about selling soon. They should have significant assets outside of a CRUT. They should at least have $1 million of that they're thinking about contributing, or it's probably not worth the rigmarole. And they should have, it'd be ideal if they had a charitable intent, although that's not absolutely necessary. So I'm going to diagram the CRUT transaction for you. You could have a grantor who sets up a CRUT. They could be the trustee of that CRUT. They contribute, in this example, $1 million to the CRUT. The way we would design it for maximum economic value to the grantor, they get the minimum deduction would be $100,000. Okay, that's the 10% of the fair market value. The CRUT would then sell the assets inside the CRUT, where it would be a non-taxable event because it's a tax-exempt entity. You could diversify into a portfolio that you normally would, like stocks, bonds, mutual funds, ETFs, whatever you're doing, and from there, and manage the portfolio considering asset location and so forth. Everything in here is tax deferred. And then there'd be a series of payments made over the term of the CRUT. In this example, I'm going to use a 10-year CRUT with a 21% payout. The shorter the term, the higher payout percentage. So it's not based on a fixed dollar amount, it's based on a percentage amount of the assets, which I think is ideal because the client will, over time, be able to outpace inflation and participate in the growth of the assets. Remember, the full $1 million gets invested here versus the after-tax amount, okay? Now, when the distributions come back to the grantor, they are differing amounts, but they also take on the tax characteristic of whatever was contributed to the trust. So if it's capital gains assets contributed in here, it'll flow out capital gains tax-wise. Now, there's a 4-tier system for how these come out. So if it comes out worst in, first out. So if there's income taxable amounts in there first, that comes out first. Secondarily, capital gains. Thirdly, any tax exempt amounts. And finally, cost basis on the back end, okay? At the end of the 10-year period, the remainder then goes to a charity. In this example, this is 10 years out, it'd be worth about $226,000, and the amount the grantor got was $1,443,000 based on a 7% growth rate. Some advisors, and I think this is a good strategy, might want to advise the clients on the possibility of replacing some of the assets that were lost, so they're not disinheriting the kids or something. But effectively, you could have that money go into an ILIT or an IDGIT, or they could be simultaneously both. As you know, there's a lot of acronyms for different trusts. But the point is this. In this example, we're taking $23,000 of some of these distributions, and we're just buying $1 million death benefit. That more than offsets the $226 here. But if you use whatever numbers you want, take a quarter of that and just replace the $225, what have you. So summarize some of the benefits here. This is a $1 million transaction, assuming $100,000 basis, $900,000 taxable, 25% rate. That means $225,000 in taxes, $775 left. If you did no CRUT. If you had the CRUT, you have the full $1 million to invest, manage inside that CRUT. You give the client a $100,000 deduction, and they'd have a paycheck for the next 10 years coming to them. And of course, as you saw earlier, they could do any number of things with that paycheck. But again, no sale first year, it's all deferred. You spread it out. Hopefully you get the client in a 15% capital gains tax bracket versus the 20. You also hopefully have income every year for the next 10 years or up to 20 years and up to lifetime. So CBS can help you illustrate this. What you need, one last thing you should be aware of is that the CRUT instrument is a calendar year instrument and not a fiscal year. Almost all illustration software shows fiscal. In the first year payment in the example I showed you was assuming a half-year first payment. So that's just a reality. CBS helps design this for you and illustrate these techniques, and of course running insurance illustrations. We also went to the extent that we're working with you and collaborating with your evaluation specialist, attorney, or accountant. We have collaboration tools using mind maps with you and your team. And to the extent that you have a case, we'd love to work with you. Our contact information is here, 763-450-1870. My email address is jeremy@cbsbrokerage.net. Thank you so much for listening.